Hello, everyone. Dave Landry here from DaveLandry.com. This is Trading Simplified. So, what are we going to talk about? Well, I want to continue my series on Jesse Livermore. I have a lot of the methodology and the action to cover first. I have a mystery chart follow up. I have two new mystery charts. We'll talk a little bit about the open portfolio and free rolling, and that'll make a lot of sense in just 1 minute. Housekeeping, I do take requests. If there's something you want me to cover, I would be happy to cover it. It makes my job a lot easier. If you need to reach me, davelandry.com/contact. If you want the slides from this presentation and all the other presentations combined, go to davelandry.com/StockCharts. Every week on Thursdays, I do a live webinar. I've been doing that for the last 20 years or so. If you would like to join me, davelandry.com/webinar. Twitter, at @TFollowingMoron, or I guess X, as they call it now. YouTube is at Dave Landry, www.youtube.com/Dave Landry. You need to find me there. All right, let's talk about the mystery charts and the methodology in action. So here's a mystery chart reveal. This is one we showed last week. Notice a nice accelerating uptrend. Didn't quite pull all the way back to the 30 EMA, but that's okay. It formed a TKO, which is a nice wide range bar down. TKO stands for trend knockout. Trend knockout knocks out the nervous Snellies, those people who may have bought at or near the high, and these people are the last in and often the first out. For higher price stocks, it also tends to suck in some shorts. And I've done complete shows just on that, so check them out on my YouTube channel and, of course, on the StockCharts channel. Oh, by the way, if you watch this video, please like and subscribe to the StockCharts channel. Like the video. If you don't like it, go have no fun somewhere else. I'm half kidding. But do subscribe to both StockCharts and my own YouTube channel. There are the parameters down below. Entry was $2.42, stop of $1.50, and an IPT of $3.34. That's initial profit target. So entry above the high of the TKO bar, stop below the low. In this case, it's kind of textbook in nature. When you have a really wide range bar, trend knockout, you can put an entry above the high of the bar and a stop below the low. And if you do the math on that, entry minus the stop, that gives you the IPT, which is the initial profit target. And we take half profits when that's hit. I'm going to flesh that out in just 1 second. Anyway, that's what it's looking like. So far, we're still underwater a little bit, coming back a little today, a little bit better than what you're seeing there. But so far, not a winning trade. But that's okay. We're going to wait on it. So that's VRM for those who were curious as to what that mystery chart was. So we'll see what happens there. I want to follow up on SYM. This was a trade where I went back to the well, so to speak. And if you take a look at last week's Dave Landry's Weekly Charts, which you can find on my YouTube channel, and also if you go back a week or so in my Trading Simplified show, you'll see me talking about the psychological aspects of going back to the well. In other words, you get into a position, you get stopped out either at a profit or a loss, and then the stock sets up again, and you decide to go after it one more time. Little hard to do psychologically, but if you can separate yourself from the setup, then you'll do just fine, and you're able to take these trades again. Anyway, we had a nice uptrend, nice persistent uptrend, nice accelerating uptrend. Pulls back to the 30 EMA to form a Landry-like pullback. If we take a look at the Landry Light at the bottom, you can see we had about 30 bars or so of Landry Light before it imploded back down to zero. And that happens when you cross or touch, I should say, the 30 EMA. Entry was here, stop was down here. You can see we lost a little bit at first, or initially it didn't work out so well. But it did end up rallying up to hit the IPT and then much, much further. And then it sets up one more time. Notice the Landry Light down below, about 20-something bars, and then it implodes to zero as soon as you touch that exponential moving average. And by the way, you can set it for a simple, exponential, whatever you prefer. I just like the 30 EMA with Landry Light pullbacks. I will use longer-term simple moving averages sometimes in the overall market with something like the TFM 10% system. So again, Landry Light pullback, another Landry Light pullback here. Entry was here, stop was down here, IPT was there. And in this case, it rallied up to the IPT and stopped us out. So let's take a look at what happened. First time, remember, when we hit the initial profit target, we bank half of our shares, or we sell half of our shares and bank $1,000 per 100K. If we're risking 2% of our account, when we're up 2%, we sell half of those shares. And that's just in case we get stopped out on the remainder. It sets us up for the potential to have a longer term trade, which first started out as a swing trade. So again, we bank $1,000 or 1%, whatever your account size is. This is based on a hypothetical 100K. I'll show you some actual trades here in just 1 second. Now, as soon as you hit the IPT, you move your stop up to break even. If that's hit intraday, you would take those profits and then you get your stop up to break even immediately. As far as trailing a stop, sometimes you will trail ahead of the IPT. Usually I do. I used to trail more on a 1-for-1 basis back here. Now I'm a little bit more lenient. I will give it a little wiggle room. But once I get into a trend, especially if it becomes an established trend, I'll give it more and more room in effort to ride out longer term corrections. In this case, it stopped out, as you can see, but that also sets up again, as I just showed, as another Landry Light pullback, and we did take the second trade too. So decent gains there. 1,000 for the IPT initially, 2,500 for the trend trading loaf. Ideally, again, when you get into these things and after you take your IPT, get your stop to break even, and you let that trailing stop gradually loosen over time, ideally you want to stick with the position for as long as you can, and hopefully, I know you should never use the word hope in this business, but hopefully you're in it for a long, long, long time. And there's been a few cases where we stayed in positions for a couple of years. Anyway, once again, it hits the IPT, but unfortunately, it came back in, and then it stopped out for the remainder at around break even. So you made 0 on the second loaf, 1,000 on the first. So you add all that up, 1,000 plus 2,500 plus another 1,000, and that comes to $4,500 on those two trades. Now, remember, this is based on a hypothetical 100K account, so that's a 4.5% move over a couple of months' time, and that's actually pretty darn good. I'd be very happy if every trade turned out that way. In fact, you might not see me again should that occur. All right, you heard me use the word hypothetical. Yes, everything I do is hypothetically based for teaching purposes, for educational purposes, hopefully and occasionally for entertainment purposes. Anyway, so here's my actual trades on this. There's one little S&G trade in here, and I was just going to try to pick up, I forget how many, 50 or so options really cheap and see if I can do a little gamma play. This is kind of a throwaway trade, what I call an S&G trade. And you can see I did lose $1 on that, so subtract $1 from my totals. But on the first trade, I made $9.88 on the first loaf, and then $26.76 on the second. Second trade, $8.62 plus 50. So we add all that up, and that's $45.76. Now, this comes from what I call my model account. I do take other trades and trades that are somewhat outside of the methodology in this one particular account, but I do try to mimic best I can what I recommended in trading service. So I think it was 388 shares or a little bit less than 400. I rounded it up to 400, as you can see here. The second time we went in, because the risks were greater, we only ended up with 200 shares, but that's how it worked out. So fairly close to what I reported on the hypothetical portfolio. All right, here's our first mystery chart for this week. Actually, I've been talking about this one quite a bit. Now, this is a little unorthodox if you're familiar with methodology. Usually after about 7 or 8 days, I'll no longer trade a pullback setup. I'll just take it off the list and find something else. But in this case, it's a first, what I call a first deep retracement in an IPO, and it's kind of more of a big picture pattern or bigger picture pattern. So I'm a little bit more lenient in a case like this, willing to give it a few days to trigger. There are the parameters down below, 45.20 for the entry, protective stop 38.50, that's a risk of 670, that's what it calls for, it's pretty volatile. And an IPT, or initial profit target, of 51.90. So let's take a look at that entry here, stop way down here, and then IPT way up there. So far, it hasn't triggered. It's come very close to triggering, as you can see the other day, but so far, no trigger. And the mantra that I believe in is no trigger, no trade. And that just so happens to be one of the things we're going to cover with Mr. Livermore this week. All right, here's our second mystery chart. As you can see, nice accelerated trend higher, followed by a deep pullback. Not quite a Landry-like pullback, but a nice deep pullback nonetheless. This is also a super volatile stock. Parameters are down below. Entry of 2, IPT of 265, risk of 0.65, and the protective stop is 135. So as I was saying earlier, with the trend knockout, especially if it's textbook where entry's above the high and stops below the low, entry minus the stop is your risk, and risk plus your entry is the IPT. If you click on that aforementioned link, davelandry.com/StockCharts, and put your information in, you'll get a blank copy of this tracking sheet if you wanted to follow along with some of these things on your own. So there's the entry, there's the protective stop, and there is the initial profit target. Again, no trigger, no trade. If you want to take a look at these for absolutely free, you can go to davelandry.com/archives and check them out. It's kind of cool if I say so myself. I know I'm a nerd, but you can see where my mind was at the time. You can look at the market, look at the charts, and a lot of times you're going to find that I say, hey, just don't do anything. And like I said last week, I preached that so often, one guy got really bored. He says, I'm going to go find another guy. And I said, well, the other guy is a trend follower. He's going to look like a freaking genius. And if you watch my last week in charts, you'll see that too. That's at youtube.com/Dave Landry. All right, let's hop into Livermore. As I've been saying each week, I'm pulling mostly from Reminiscence of a Stock Operator. We're on chapter 10, and we have been for a couple of weeks. But I'll also use the biography by Richard Smitten for a little color commentary. And then as I eventually wrap up this series, I thought it would just be a couple of weeks, but it looks like it's going to take me a little bit longer than that. We'll pull a little bit from How to Trade Stocks by Jesse Livermore. This one has some updates by Mr. Smitten, and I don't know if I fully agree with his updates, but he does pull a lot of this book, Reminiscence, into it, and some of the color commentary from the biography. Do read the biography, a lot of good stuff in there, and it's pretty interesting. But in order that you should read them, I'd read them Reminiscence, read this one every year, at least once a year, and then read the other two to kind of fill in the gaps. All right, when we last left off, Livermore was once again discussing the perils of being ripe and early. He got in cotton early, and he tried to force it to break out. Cotton's just kind of chopping around. He thought, hey, what if I just gave it a little bit of a nudge, because I've got a nice big position that I've built while it's in the base. Maybe I could force it to break out. What's kind of interesting, a little spoiler alert here, later on he's going to talk about how you shouldn't be in and out of the market, especially when it's very dull. And basically he says, let those people fight it out. And looks like he learned the lesson here. It cost me about $200,000. I was done with it. It wasn't very long after that when it began to go up and never stopped till it got to a price that would have meant a killing for me if I hadn't been in such a great hurry to start. The secret to timing a market is not so much beating the market, it's not letting the market beat you. So he was right but early here, but he let the market and beat him by being impatient. So as we've discussed quite often, being right but early equals being wrong. It's okay to have a strong opinion about something, but of course you want to wait for confirmation. This experience has been the experience of so many traders so many times that I can give you this rule. In a narrow market where the prices are not getting anywhere to speak of but move within a narrow range, there's no sense in trying to anticipate what the next big movement is going to be, up or down. The thing to do is to watch the market, read the tape, and determine the limits of the get nowhere prices, and make up your mind that you will not take an interest until the price begins to break through the limit at either direction. A speculator must concern himself with making money out of the market and not with insisting that the tape must agree with him. Never argue with it or ask it for reasons or explanations. You get paid to make money in markets. You don't get paid to look smart. And trying to look smart by getting in early is going to cost you a lot of money over the long run. So forget about being right or trying to be early. Focus on doing the right thing. Wait for that market to begin to commit in one direction or the other, and then look to get on board. So Livermore was asked by some people who wanted to make a quick buck in wheat. And this is how he answered them. He was actually bullish on wheat, but only if it began to rally through 120. If you want to make some money out of wheat, I could tell you how to do it. They all said they did, and I told them, if you are sure you wish to make money in wheat, just watch it. Wait. The moment it crosses 120, buy it, and you will get a nice quick play in it. Why not buy it now at 114? One of the party asked. Because I don't know yet that it's going up at all. Then why buy it at 120? It seems a mighty high price. Do you wish to gamble blindly in the hope of getting a great big profit? Or do you wish to speculate intelligently and get a smaller but more probable profit? They all said they wanted the smaller, surer profit. So I said, then do as I tell you. If it crosses 120, buy. Now, as I've said ad nauseum, a lot of times I'll recommend a stock, and then people complain to me 6 months later. I'll argue back that, hey, I never recommended that stock. You got to be confused with somebody else. The stock's going straight down. Why would I recommend it? And then they'll back me up a few months and say, you recommended it back here. I'm like, yeah, but it never triggered. In this case, it's just a quick example that comes to mind from May. TFPM. This one might have even been a mystery chart. Anyway, it was a nice little TKO. It's a pattern, in this case, it's kind of a double top knockout. You see it makes this minor double top and then makes this TKO. And those are some of my favorite, or often my favorite, because people think this market has topped, especially does a shakeout move. If it goes right back up, it catches a lot of people off guard. And remember, we're trading traders, not markets, and we're using technical analysis to read the psychology of the players. And at the same time, trying not to get too caught up in the excitement. That's a trading psychology. Anyway, as you can see, it just imploded, never did trigger, though. Now, let's say that the morning after I recommended it, you decided, well, I'm just going to go ahead and buy it early. Well, that mistake, at least at the lows, would have cost you $2,873, or a 2.8% loss on a 100K account. So sometimes it's cheaper to pay more. And it's a little counterintuitive, especially if you're a little newer to trading. But I would rather pay up for a stock than get it cheaper and lose a lot of money. Pay up and make money, that is. What I've told you gives you the essence of my trading system as based on studying the tape. I merely learned the way prices are most probably going to move. I check out my own trading by additional tests to determine the psychological movement. I do that by watching the way price acts after I begin. Now, he does scale into positions, which I'm not a big fan of, just because of the way I trade, at least with the core methodology. What I'm looking to do is, I'm looking for a swing trade. So if you're looking for a short-term move, you need to go ahead and put up all your shares at once. Or you need to buy all your shares at once. That way you can flip them out if you're blessed with that swing trade profit. Now, he's establishing huge positions, and he talks a lot about paying up. So if he buys a stock, let's say at $50, if it goes to 49, he's not going to buy any more, and he might soon be out. But if it goes to 51, he might put on his next loaf, and so on and so on. And he always builds his position at higher and higher prices. And there's nothing wrong with that. Conceptually, that makes a lot of sense. The reason I do it the way I do it is because I am looking for that short-term move, and if I wait a couple of days, that move might have already happened, and I'm buying into higher and higher prices, and it's too late by that point. It is surprising how many experienced traders there are who look incredulous when I tell them that when I buy stocks for a rise, I like to pay top prices, and when I sell, I must sell low or not at all. Buy stuff that's going up, sell stuff that's going down. If it's going sideways, leave it alone. I used to drop mics, but I've ruined a few. But that's almost a mic drop right there. It would not be so difficult to make money if a trader always stuck to his speculative guns. That is, waited for the line of least resistance to define itself and began buying only when the tape said up or selling only when it said down. So just getting back to this sim example, you could see the entry when I first recommended it was well above the market back here, and you had a bit of this like TKO move. That's why the entry's right here, because the wide range bar down. So I paid up for it, as Livermore would say. Stop was there. IPT again was there. We trailed the stop higher, and then we stopped out. Now, the line of least resistance, draw your big blue arrows. For those of you who aren't familiar with my big blue arrows, they came about because the first paint program I had way back in the 90s, when I first started providing online commentary, the paint program defaulted to blue. I think it was Paint Shop Pro 5 or something like that. Anyway, so as you can see, as Livermore said, establish a line of least resistance and then look to figure out a way to get on board. And then again, I paid up on the stock. Now, you could eyeball the line of least resistance. I would strongly recommend you do that, but also you can use stuff like Landry Light, which I have plotted down below. So again, I paid up on this position. On both positions, after I got stopped out, I paid up again, meaning that I bought as the stock continued higher. If the stock right here, I forget what our entry was, somewhere in here, kept dropping and never to hit that entry, then once again, no capital would have been put into harm's way. So I pay up, I take partial profits in case I'm right small, and then I trail the stop loosely just in case I'm right big. But the initial stop is just in case I'm flat out wrong. So again, IPT in case I'm right small, and a trailing stop in case I'm right big. And yet again, pay up in your positions. Don't try to catch a falling knife. Wait for them to go up. Now, Livermore talked a lot about waiting for your pitch, so to speak. It always pays a man to be right at the right time. You need to be mentally and monetarily prepared when the next big trends come along. This is my writing, not Livermore in this particular case. And that's the point I'm trying to make. Livermore talks a lot about losing your nerve like he did when he bought cotton too early. If you're trying to grind it out, and the market's not trending, when the market begins to trend, you've lost so much money, you're not in a good position mentally and monetarily to take advantage of the trend. Like I've said 1,000 times recently, the next guy is going to look like a genius because this client was bored with me because I was doing nothing, but that's what you should do. And often when I am doing nothing, I explain to my clients that I really wish someone 20 years ago would have told me to do nothing when there is nothing to do. And that's one of those secrets of trading. Doesn't sound like that big of a deal. Don't buy anything while it's going sideways. But it is. You'd be surprised at how many people try to get in early. Well, that's all my time for this week. Again, if you need to reach me, davelandry.com/contact. You can find me on YouTube at youtube.com/Dave Landry. If you want the slides for this presentation, all the other presentations combined, davelandry.com/StockCharts. And join me every week on Thursdays for Dave Landry's The Week in Charts. If you register once, you'll be registered for all. I want to thank everybody for watching, and may the trend be with you.